Can a teenager save enough for a home down payment? Imagine being a teenager and dreaming of owning your own home someday. It might seem far off now, but with the right plan, it's possible. Saving for a down payment is all about setting goals, staying disciplined, and making smart choices. A down payment is the upfront cash you pay when buying a house. It usually ranges from 3% to 20% of the home's price. For example, on a $300,000 house, a 20% down payment would be $60,000. Some loans, like conventional loans, requiring as little as 3 to 5% down. Others, like Federal Housing Administration loans, might need just 3.5%. There are even government-backed loans that sometimes offer 0% down. Most experts recommend saving 20% because it helps you avoid private mortgage insurance. This is extra cost added to your monthly payment if your down payment is less than 20%. Putting down 20% also lowers your interest rate, which can save you thousands over the life of the loan. Plus, a bigger down payment means borrowing less money, so your monthly payments are smaller and easier to manage. Let's do some quick math. The average home price in the country is around $360,000. A 20% down payment on that is about $72,000. That sounds like a lot, but breaking it down makes it easier. If a teenager saves $600 a month and has 10 years before buying, they will save $72,000, especially if they earn interest on their savings. If they can only save $300 a month, it would take about 20 years to reach that goal. Teenagers can earn money through part-time jobs that pay around $15 to $20 an hour. Working 15 hours a week at $15 an hour earns about $900 a month before taxes. After taxes, it might be around $750. Summer jobs, internships, or freelance work like tutoring or lawn care can add to their income. Starting to save at age 16 gives a good amount of time, 10 to 12 years, to reach a down payment goal. The longer the timeline, the more interest can help grow the savings. Even earning just 4 or 5% interest annually can make a difference over time. To make saving easier, teenagers should open a high-yield savings account that offers better interest rates, around 4 to 5%. Automating savings by setting up automatic transfers right after they get paid helps avoid the temptation to spend the money. Creating a clear plan on how much to save each month based on their goal keeps them motivated. But remember, saving for a down payment isn't just about the house price. There are additional costs like closing costs, which can be 2 to 5% of the home price. For a $300,000 home, that's $6,000 to $15,000. It's smart to aim for a bigger down payment, like 10 or 15%, to cover these extra costs and keep monthly payments manageable. From a financial wellness point of view, starting early teaches good money habits. Teenagers learn about goal setting, patience, and how compound interest works. These skills will help them throughout their careers and adult lives. If they plan to pursue a high-paying job later, they can save more quickly. If they start with lower-paying jobs, their earnings will grow over time, allowing them to save faster as they advance. So yes, a teenager can save enough for a home down payment. It takes planning, consistent effort, and smart saving strategies. With about 10 to 15 years and saving around $500 to $800 each month, they can reach their goal. The key is to treat saving as a priority and set up automatic transfers so it happens without much thought. Starting early not only helps build a down payment fund but also builds the financial skills that will serve them well in their careers and future.